What's up, guys? Ron Carter here, and today I just wanted to share some things that I've learned that I think might help if you're just getting started investing. And this doesn't these principles apply regardless of however you're investing, whether you're investing or you're interested in investing in stocks, real estate, private equity companies, whatever it is that you're looking to invest in, maybe just money market accounts and high yield savings accounts. And so these are some rules that I followed to help me really be able to get started. And so number one, I'm going to make this kind of quick. This is on the fly because I'm in the car. I'm getting ready to go to school here in a little bit. So number one is really having a chunk of cash to not only just to invest, but to also have as like your security blanket. So here's what I mean by that. Like me personally, right now I have about 3 months of income saved up, not 3 months of living expenses, of my income, of like what I usually make per month. I have that just stored away in a high yield savings account. It's actually almost 4 months of it. And I'm not going to take all that cash and just dump it into an investment. I want that just sitting there secure in a high yield savings account, something that's giving me at least 4% return per year. So that money's still growing, but I know that I have access to it in case there's an emergency in life, something pops up. Things happen in life. You know, you could be driving down the street and all of a sudden you have 4 flat tires. You know, like things like that happen, you know? And so, having that sitting off to the side while you have other cash in investments is going to be beneficial. And this is what it will prevent, because this is what I used to do. I didn't do this before, and I would start in like looking at stocks and researching stocks, and then I'd buy a bunch of stock and I would spend all my money, like everything that I had, like on some stocks. And then like a month later, some emergency happens and I'm like, oh, I need to get that money. And then I pull it out. And regardless of what the stock is doing, it can be up, it can be down from when I invested. Because I don't have anything saved and off to the side, I need to get that money. And I've done that so many times, like maybe like 3 or 4 different times in my life. And because of that, I end up getting a loss on my investment because I pull the money out because I need it, and I don't even care what the stock is doing. The stock is down, so what? I need this money. And so then I go sell the stock, and then I don't have any investments anymore. And so that's the first thing to really do, is to make sure that, and so the way that I'm doing this is I take 30% of my income and I put it in my high yield savings account every month. Just 30%. Sometimes some emergencies happen. Like I had some dental surgeries a couple weeks ago. And so that number that I put into there wasn't as much as it usually is, but on average, I like it to be 30%. And I want to continue doing that until I have at least 6 months of income, of my monthly income in there. Then I can kind of reduce that a little bit, and I could reduce that to maybe like 10% of my income, and that other 20 I could deploy towards investments every month and feel comfortable doing it, knowing that, hey, if something were to happen, if like relative got sick or something like that, and I have to take an emergency flight somewhere, like I could always pull that out of my savings if I need to. The best case scenario is having that high yield savings account with the 6 months of living expenses, or not living expenses, 6 months of income in there, and also having a chunk of change in your just regular savings account for emergencies. That way you don't even have to pull out of the high yield savings account. And so that's the first rule, having 6 months of income. And number 2, I would say this is the second thing, is before you decide to invest, like, so here's me, right? This is what I do. I get all excited about things. I start learning new things. I start listening to podcasts. I've been on this multifamily real estate kick for a long time. Like I just got done with this hour drive from my house to school, listening to a multifamily real estate podcast talking about buying 100-unit apartment complexes, right? And so what I want to do when I'm all excited about something is I want to take all my investment money, or all the money that I have for investing, and deploy it towards that thing I'm excited about, the new exciting thing. But meanwhile, I have all this knowledge about other industries already. And so for me personally, like the other industries that I have knowledge about, it's like digital marketing, running ads on Meta, on Google, growing my own personal email list, making content like this. I have more knowledge there because I have hands-on experience. The knowledge that you gain from hands-on experience is always more detailed, and you have more context than any knowledge that you get from just listening to podcasts over and over again or reading books about something. And so the reason why I bring this up is a big mistake that I've heard that a lot of investors make is that they invest in things they don't understand. And so here's like my pie chart for investing. If you imagine a circle right here about when it comes to business and like my understanding of things, about 70% of my understanding is in the online marketplace. When it comes to building websites, running ads, social media, selling offers digitally, and then probably like, I would say the other 20% of that pie chart is stocks, and the other 5% is like Bitcoin, and then another 5% is multifamily real estate. So what this means is that, let's say that I have $2,000 that I can invest every month. Well, 70% of that $2,000 that I have should go towards something that's involved with digital marketing, because that's where 70% of my understanding is, right? The other 20% should go towards stocks, different stocks and stuff. The other 5% goes into Bitcoin. Other 5% could squirrel it away for multifamily, like one day. And this kind of goes against everything that I naturally want to do, because naturally I'm really excited about the multifamily thing. Why am I so excited about it? Because I don't have experience in it at all. It's new, it's novel, and so naturally I want to take the bulk of what I can invest and put it into the thing that I'm really excited about right now. But that's not the way to be really successful with your investing. And so what am I doing, right? So yeah, I do buy stocks every month. I buy a little bit of Bitcoin. I save for multifamily, but I run ads. I have a free community where I give tips in digital marketing. When people join it, they join my email list, and then they can buy other offers for emails that go out that I've already written, where I'm recommending different things, softwares, tools, things like that. They also go to different YouTube videos. And so it's like 70% of what I invest should be going towards just running ads to that and building that asset. At least for right now, until I have more understanding in other things, and then I can like fluctuate those, and I can fluctuate those numbers and shift them around. So just quick recap, right? Making sure that you have 6 months of living expenses, or not living expenses, but income. You can start off with living expenses, but 6 months of income is best. You have 6 months of your income just in a high yield savings account. You want to open one of those. Don't park your money in your regular checking account. You're just losing money if you're doing that, because the reason why you're losing money, you may get interest on your checking account, on your regular savings account, but the interest that you get is lower than the rate of inflation. So every year, inflation's at like 2-3%. It's usually hovers somewhere in between there, right? And let's say inflation is at 2%. And let's say that your checking account gives you 1% APR. So you have 1% interest on the money that you have parked in your checking account. Well, if you have $100,000 in your checking account, well, next year, your bank will give you an extra $1,000. They'll say, hey, thanks for keeping your $100,000 here. Here's your 1%. Here's another $1,000 added onto there. But at the same time, if inflation goes up by 2%, Like, you may, at the end of the day, you may have $101,000 in your checking account, but you'll only be able to buy the same amount of stuff. Your purchasing power, that's what that means. You'll only be able to buy the same amount of stuff that you would have been able to buy with 99 grand, because inflation went up. So you want to make sure that wherever you're parking your money, the interest that you're gaining, the number on the interest, is higher than the rate of inflation. So if you have a high yield savings account where you're getting at least 4% interest on the money that you have parked there, inflation could be at 3%, which is like pretty high. And just by having your money parked there, it's not getting eaten up by inflation growing. Your purchasing power with that money is still growing over time. So save your money in a high yield savings account. Have 6 months of your income in there. And then after that, you can taper that down and start deploying it towards other investments, things that you actually have some hands-on experience with, or whatever you're the most knowledgeable in. Maybe you don't have hands-on experience, but you're really knowledgeable about one thing compared to another. Well, start investing in that one thing, and that's how you get hands-on experience. Anyways, super quick video. Hope this was helpful for anybody that's just getting started investing or wanting to get started investing. I'm gonna go to class now. Hope you guys are having a good one. See ya.